stand by. Good day, ladies and gentlemen, and welcome to your Dynatronics second quarter 2020 earnings conference call. All lines have been placed on a listen-only mode, and the floor will be open for your questions and comments following the presentation. If you should require assistance throughout the conference, please press *0. At this time, it is my pleasure to turn the floor over to Mr. Skylar Black, Corporate Controller. Sir, the floor is yours.
Good morning, and thank you for participating in today's call. I am Skylar Black, Corporate Controller and Head of the company's Investor Relations. With me today is Brian Baker, our President and Chief Executive Officer, and David Werthland, our Chief Financial Officer. This morning we issued a press release announcing the financial results of our second quarter ended December 31st, 2019. On today's call, Brian will provide some initial commentary. Then he will turn it over to David for a financial report. Following David, Brian will confirm our guidance for the 2020 fiscal year and provide closing remarks. The operator will then open the phone lines for questions. Before we begin, let me remind you that during the course of this call, we will make forward-looking statements regarding our current expectations, plans, projections, and financial performance relating to our business. These forward-looking statements reflect our view as of today only and involve risks and uncertainties that could cause our actual results to differ materially from those discussed today. Important factors that could cause actual results to differ materially from those projected or implied by our forward-looking statements are included in our most recent 10-K and other reports filed with the SEC. We caution you not to place undue reliance on forward-looking statements we make this morning. We undertake no obligation to update or revise forward-looking statements.
Thank you, Skylar. This is Brian Baker, President and Chief Executive Officer. I want to welcome Skylar, our Corporate Controller and newly appointed Head of Investor Relations. Skylar has been a key leader in the organization for the last 2 years, and we look forward to his contribution in this new responsibility. For the quarter ended December 31st, 2019, we are pleased to report that we achieved our sales objectives for each of our major brands, Houseman, Bird & Cronin, and Solaris. As a reminder, Solaris is the most recognized brand in our electrotherapy product portfolio. Our teams are committed to achieve stated sales objectives for each brand every quarter. Our commercial teams are implementing improved sales analytics that provide new insights regarding sales trends and opportunities. Our operations teams continue to excel in delivering our products when and where they are needed. We remain on track to achieve our fiscal year sales guidance, which we are narrowing between $59 and $61 million for the fiscal year 2020. In the second quarter ended December 31st, 2019, we reduced SG&A by $155,000 and improved operating profitability by $61,000 compared to the same quarter last year. In the first 2 quarters of fiscal 2020, we've reduced SG&A by $727,000 and increased operating income by $239,000 compared to the first 2 quarters of the prior fiscal year. Our operating activities in the second quarter generated $924,000 in positive cash flow and $2.9 million in positive cash flow for the first 2 quarters of this fiscal year. We reduced our line of credit balance to $4.8 million as of December 31st, 2019. Our positive operating cash flow in the second quarter was driven largely by reductions in net working capital. All of these financial results reflect continued discipline to the operating plan and progress in executing to our strategic initiatives. In the coming months, we will continue to drive operational changes that will reduce cost, improve profitability, and position us well for the next fiscal year. To accelerate execution of our operating plan, we continue to enhance talent in key areas and consolidate administrative functions to our Minnesota location. We recently appointed Jason Anderson to our Chief Information Officer. You may recall that Jason is a member of the Cronin family that sold the Bird & Cronin business to Dynatronics in 2017. Jason brings a wealth of knowledge, having over 25 years' experience running technology, operations, and business strategies. Before joining Bird & Cronin as co-president in 2014, Jason was a partner and CIO of Epicor Wealth Management. We are also recruiting for a Director of Sales Operations Rehab, a Group Controller, and a Director of Supply Chain. All of these positions are headcount neutral and planned in our budget. These individuals will be based in Minnesota and will work closely with my senior leadership team. The Director of Sales Operations Rehab will have responsibility for the Solaris and Hausman brands. The short-term focus will be to assess the competitive landscape, refresh product content, and launch marketing campaigns. The Group Controller will be responsible for building high-performing teams to standardize and streamline our accounting processes, identify cost improvements, and improve our working capital metrics. The Director of Supply Chain will focus on strategic sourcing projects, SKU management, and implementing our S&OP processes. This year, we will be launching a new e-commerce store. This up-to-date platform will improve the customer experience through ease of use, organized landing pages, and customized ordering portfolios. This exciting innovation will augment our sales channel for those customers who choose to transact in the evolving digital sales ecosystem. We aim to be a recognized standard in restorative solutions. During fiscal 2020, we continue to execute on our operational plan, build customer relationships, and reduce complexity, all of which position the company well to drive modest mid-single-digit organic growth, improve profitability, and execute on our acquisition strategy. David will now provide a financial report.
Thanks, Brian, and good morning, everyone. Net sales for the second quarter ended December 31, 2019, decreased $243,000, or 1.6%, to $15.2 million, compared to $15.4 million in the same quarter of the prior year. The decrease was primarily due to a reduction in sales of physical therapy and rehabilitation products. Gross profit for the quarter decreased $94,000, or 2%, to $4.6 million, representing 30.2% of sales, compared to $4.7 million, or 30.3% of sales in the same quarter of the prior year. Lower sales were the primary cause of the decrease, reducing gross profit by approximately $74,000. The decrease in gross margin percentage to 30.2% from 30.3% contributed about $20,000 to the reduction in gross profit, driven primarily by lower sales in our physical therapy product lines. Selling, general, and administrative expenses for the quarter decreased approximately $155,000, or 3.2%, to $4.6 million, compared to $4.8 million in the same quarter of the prior year. The decrease was primarily due to lower selling expenses of $197,000, consisting primarily of lower fixed sales management salaries and lower commissions. Net loss for the quarter was approximately $137,000, compared to net loss of $441,000 in the same quarter of the prior year, which included $204,000 in income tax provision. Operating income improved $61,000 for the second quarter of fiscal 2020 compared to the second quarter of fiscal 2019. As of December 31, 2019, we had cash balances of approximately $532,000. We have an $11 million asset-based line of credit, pursuant to which we had borrowed $4.8 million. This is a $1.7 million reduction from the $6.5 million balance at June 30, 2019, and reflects decreases in our working capital accounts and positive cash flow from operating activities since June 30. Our line of credit balance is currently averaging about $5.5 million, and we have availability on our line of credit of about $2 million based on our current borrowing base. In the second quarter ended December 31, 2019, we fully paid all remaining liabilities from our prior transactions. This concludes our summary of operating results. I will now turn the call back to Brian.
Thank you, David. In terms of our guidance for fiscal year 2020, we expect consolidated net sales to be in the range of $59 million to $61 million. We expect the distribution of our revenue between quarters to align with historical trends. Consistent with the past 2 fiscal years, we expect to generate positive cash flow from operating activities in fiscal 2020 with some volatility in quarters based on working capital changes. We expect gross margin to be in the 31% range and SG&A to be about 31% of sales for the current fiscal year, including approximately $1.8 million or 3% of sales in non-cash charges. The number of common shares outstanding is currently 9.9 million, which increased 760,000 in the second quarter due to a conversion of Series C preferred to common. We expect our outstanding common shares to normally increase in the range of 240,000 per quarter, depending on our share price. The total number of common and preferred shares outstanding is currently 14.1 million. In my role as President and CEO, I continue to visit key customers to form stronger partnerships and gain greater access to the markets we serve. We attended the Performance Health Summit earlier this month as a gold partner. We are also excited to be attending the American Physical Therapy Association Combined Sections meeting this week in Denver, as well as the American Academy of Orthopedic Surgeons 2020 annual meeting in Orlando next month. At these events, we will meet with key customers and seek to develop new distribution relationships. In addition, we will demonstrate the most recent design changes to our proprietary torque table, which offers unique features to support therapist stretching techniques. We also continue to share our story and build relationships with the investor community. We attended the 8th Annual Roth Utah Corporate Access event in December. We'll also be presenting at several investor conferences in the coming weeks. As a reminder, our focus for the current fiscal year is to lay the operational foundation to scale the business. This foundation will position the company for mid-single-digit organic revenue growth and enable the continuation of our M&A strategy going forward. We appreciate and thank our investors, the investment community, and employees for their ongoing support. We are committed to effectively serving our customers by providing innovative, restorative solutions. I will now turn it over to the operator for questions.
Thank you. The floor is now open for your questions. If you do have a question, please press star 1 on your telephone keypad at this time. Questions will be taken in the order they were received. If you are using a speakerphone, we ask that while posing your question, you pick up your handset to provide favorable sound quality. If at any time your question has been answered, you can remove yourself from the queue by pressing 1. Again, ladies and gentlemen, if you do have a question or comment, please press star 1 on your telephone keypad at this time. Please hold while we poll for questions. Our first question comes from Jeffrey Cohen of Ladenburg Thalmann. Please state your question.
Oh, hi, Brian and David. How are you?
Yeah, good. Good morning, Jeff.
Morning. So could you give us a sense on FTEs over the past quarter or quarter plus, just generally speaking? What kind of movement have you seen up or down?
FTEs? Was your question FTEs?
Full-time employees, yes.
Yeah. I don't have the exact number, but we're in the low 300 range. Yeah, I think that we're, Jeff, probably right around 280, a little bit above 280 right now.
Okay, got it, perfect. It sounds like, generally speaking, the trends are going in the right way. So just trying to get a better idea, you talk about mid-single digits growth. You think that's, commencing March, June, end of the calendar year, and holding through 2020, not taking into account any M&A acquisitions? Is that a good kind of estimate on our model?
Yeah, if we look at fiscal year 2020 and the guidance that we've recently narrowed to 59 to 61 million, we feel good about meeting those numbers for fiscal year 2020. Looking at the next fiscal year, we don't talk yet to the guidance that we're providing for the next fiscal year, but I'd say that we are positioning the company well to move into this modest single-digit growth beyond this fiscal year.
Okay, got it. And you think, Brian, that possibly carries over also to your margins? Looking at your margins, it look like the back half of the year is better than we previously thought. So does that kind of cadence upwards, or do you expect that to be lumpy? Don't try to read into it too much. Q3 versus Q4, and then can that carry through? You expect that you could do the mid-single digit growth on the margins?
Yeah, on the margin, we feel pretty good about where we're at with our operational foundation. We think we've got plenty of capacity in our plants where we're distributing our products. We don't think we need to add any fixed costs. So as we start to see the sales volume increase, we think that will have an effect on gross margin. We're not really speaking in any detail of what we think that could contribute as we see the sales volume increase.
Okay, got it. It looks like you're getting out there more as far as conferences and trade shows, which I'm encouraged to see. What was that mentioned? Was that a torque table? Could you talk about that a little bit, what it is, where it's manufactured, what it's supposed to do, and could you also talk to us a little bit about some of the other innovation going on and any innovation related to Solaris?
Yeah, I'm speaking to the torque table first. That is a Hausmann branded product. It's a proprietary product. We licensed the technology from the inventor. What this torque table does, what's unique about it, Jeff, is it anchors the patient in place. So as the therapist is applying a stretching technique, he's able to do that stretching technique with having the patient anchored. You can kind of imagine if they're on a normal treatment table and I start to pull on the patient's legs, for example, they're going to just start to slide. And so the therapist has got to put some opposing force on the patient to keep them in place. The torque table provides this anchoring system. And it's really a fun product, Jeff. When the therapists look at it, it's kind of this aha moment. Why didn't I think of this technology? So we're pretty excited about launching this product, and it's something that we're going to be showing this week at Combined Sections in Denver. Other things that we're doing with product innovation, the Solaris product, we're looking at refreshing that product. The way that we're looking at that is putting a quick start menu in place so that it's easier for the therapist to get the desired treatment they want quicker, so that they can move on and treat other patients after they've started that treatment on the Solaris product.
Got it. Okay, that's perfect. I'm just looking at the other questions that I had. So production of cash from operations for the entirety of fiscal 2020 is your outlook, correct?
Yeah, no, our guidance is that we're going to be positive cash flow for the year. We've as we mentioned, we've generated $2.9 million in the first 6 months. We're going to have some volatility in the quarters, but we do, continue to expect to generate positive cash flow.
Okay, and then lastly, Brian, could you talk a little bit about the M&A front, just kind of big picture speaking, as far as what you're seeing over the past months, as far as availability of entities, what's out there, trends on valuations or pricing, et cetera. Thanks.
Sure. We do maintain a pretty strong pipeline of acquisition targets, Jeff. We do have new targets come in occasionally, and we're assessing those from really a value-oriented mindset. But we do maintain communication with those targets, and when it's really the right timing for the owners to sell, or we get to the valuation that we believe the businesses are worth, then we'll explore moving those forward at the right time.
Okay. Thanks for taking the questions.
All right. Thank you,
Thanks, Jeff.
Our next question comes from Anthony Vendetti of Maxim Group. Please state your question.
Yes, hi. I was just wondering, Brian, can you talk a little bit about the outsourcing, how that's going? What % of products right now are outsourced to a contract manufacturer? How many are you still producing?
Good morning, Anthony. Thanks for the
Morning,
question. The outsourcing of their electrotherapy line, and we're making really good progress on that front. We've gone through a qualification plan with our contract manufacturer, and they're almost completely qualified. So then we'll start planning on what portion of manufacturing, the percent of what we need in as far as demand, what we'll start pushing over to that contract manufacturer. So I'd say that we're on track and on schedule with what we planned with that. And that's really what we're looking at outsourcing as far as manufactured product. We do some strategic sourcing on other product lines where we're sourcing product from overseas, and that's really nothing new. It's the same products that we've historically sourced from other manufacturers.
And when you completely move it, that electrotherapy line to contract manufacturing, that obviously will contribute to the margin, the long-term margin goal. Can you give me an idea of what the gross margins would be on that particular product line when it's fully outsourced?
And we're not really talking specific to what we think the margin differences will be, Anthony. It is something, say, over the next 6 months or so that we'll start to see the effect of that move that will start to come through on our P&L. And we do think that it's going to have a good effect on not only gross margin, but what we'll see in earnings as well.
Okay. And then I know you said you still had some products, and you know this is a constant process of reviewing the product line and calling duplicative or unnecessary products as you've put together the three divisions. Can you talk about where that's at? How many did you call this quarter? Are you largely done with the initial calling and now it's just an ongoing process?
Yeah, we're finished, Anthony, with the SKU rationalization project, if you will, where we went through and looked at products that weren't necessarily profitable or didn't fit well within our product portfolio. We've been done with that project for quite some time. There are opportunities where we have duplicate SKUs. I'll use stools as an example, and we're looking at what line should we be carrying and get rid of those duplicated SKUs, which will not really affect revenue in any way because we'll just move them over to the models that we choose to have in our portfolio. But it will give us an opportunity to reduce inventory because we're not carrying duplicate inventory. And we're working on that over the next, say, 3 to 4 months. And then,
okay,
like you mentioned, Anthony, everything else is kind of just ongoing management, how we look at product lifecycle management.
Okay, great. Thanks, Brian. Appreciate it.
Thanks, Anthony.
There appear to be no further questions at this time. I will now turn the conference over to Brian Baker for closing comments.
Thank you for the questions and for your interest in Dynatronics. If you have any further questions, please direct them to our investor relations contact, Skylar Black. Operator, you may end the call.
Thank you. This does conclude today's teleconference. We thank you for your participation. You may disconnect your lines at this time, and have a great day.